This is the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Any postings and or social media content are the views of the advisor and do not necessarily reflect BMO's position or viewpoint. The information herein is for Canadian residents only and does not constitute any financial, legal, tax, investment, or other advice. There is plenty to discuss today. Welcome to the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. I'm Terry Evans. We are here with episode number 37 for the week of March 20th, 2026. Patrick, I'm no expert. You are the expert on this podcast, but I'm just looking. The past month is pretty flat, and year to date, believe it or else, we're up 4% on the TSX. I don't think that's anything that anybody expected considering what's going on in the world right now.
No, certainly not. I think specifically with the Canadian market, we're definitely benefiting from the energy component. You know, North America in general is energy self-sufficient. So that is probably sustaining our markets. Now, as I say that, I am expecting the volatility to pick up through the course of the week. We've already noticed with the CBOE, which is this measure of volatility in the market, we have seen that index steadily increasing last week and into this week. And on Friday of this week, we have a option expiry date. And we actually have 4 different types of options all expiring on Friday. And this is an event that happens about 4 times a year. It's going to happen this Friday. And so the investors in the market that largely use options, which tends to be institutional investors and hedge funds, is they have to make some decisions with regards to those options, whether or not they're going to roll them over or let them expire. So I would say taking all of the really apparent reasons why there should be volatility in the market, and then take some structural additional reasons why there could be volatility in the market, is it wouldn't surprise me if this week, especially if we kind of see much of the same, the destruction of some oil infrastructure, in the region, all these things could lead to higher volatility in the market. Now, I think that actually might be one of the reasons why we're seeing gold actually selling off of its high. And so we often talk about gold being the safe haven asset, and I do think that it is. But it also has a interesting correlation with the US dollar. One of our base cases for gold going up is that we, looking at 2026, we assume that the US dollar would have some weakness as the US central bank lowered its key interest rate. So we felt that there'd be a little bit less demand for the US dollar. And then, of course, just with global trade, we felt that there'd be less demand for US dollars. And so with less demand for US dollars, that could be something that would perhaps be driving the price of gold. Well, one of the things that's happened in the last couple of weeks with the significance of the action that the US is taking is that it's actually driven the US dollar up versus a basket of other currencies, specifically other currencies of nations that are being more impacted by the higher price of energy. So now the Canadian dollar has also seen its currency rise versus a basket of other currencies while it stayed relatively stable versus the US dollar. And perhaps gold's weakness has benefited Bitcoin. It's up about 5% since our last podcast. And to your point, with the, and we talked about this in last week's podcast, is we were expecting more volatility in this particular situation. And where we're at right now is on a year-to-date basis, the U.S. market is down about 2% year-to-date, even though it's relatively flat today and maybe down a percentage point since last week. So expect this period of time where we've held up pretty well to perhaps roll over. I would say, kind of set the expectations there. Wouldn't surprise me if some investors are holding on to a little bit more cash, maybe being a little hesitant to put money to work right now while there isn't as much clarity in the market.
Shrinkflation is something that's been a topic of conversation for a lot of people from a consumer point of view. There's another thing called stagflation that's out there. What is stagflation?
Yeah, stagflation is nasty. So what stagflation is a combination of higher prices. So when we look at inflation and lower growth. Now, probably to the casual observer, a person would say, well, that doesn't sound, so unusual from what we always seem to be experiencing. But stagflation can be very dangerous kind of once it sets in to a region like a country or an economy. And the reason for that is that the cure for any of the components of stagflation, so either lower growth, so perhaps we see GDP, gross domestic product, falling off. Maybe we see the unemployment rate going up. Those would be signs of slowing growth. And then higher prices. When, say, the central bank or government looks to try to fix one of those components, is that they can actually make the other component worse. So, for example, if you were to lower interest rates to help out the economy, which we've seen in the past, is that could go and feed inflation. If at the same time you're trying to fight inflation because you've got higher prices, and so you decide to increase interest rates, you're going to invariably slow down the economy and probably lead to higher job losses. And so, about 2 weeks ago now, we saw an unexpected big jump in US unemployment. Now, I still don't think at an unemployment rate of 4.4% in the US that this is something to get too excited about yet. Because compared to Canada, where we've got unemployment in the 6.5% range, the US is a much larger economy. Most Americans still have jobs. And certainly on a relative percentage basis, they look far better off than we do here in Canada. But a $94,000 unexpected increase in job losses is significant. And so if we were to see this 1 month turn into a quarter turn into consecutive quarters, then we're going to have to kind of revisit what our outlook for economic output is going to be. So, we may see market conditions kind of self-correct here, but we're certainly going to be, the central bankers, specifically in the US, where we expected action, so rate cuts this year, it puts them into a tough spot. Canada, not so much. Here in Canada, inflation has at least so far remained relatively stable, and we weren't planning any interest rate cuts here in Canada for this year anyway.
How is the Canadian economy doing as we approach the end of the third month? Is that technically first quarter sort of thing? Is that what we're looking at?
Yeah, so we'll be, we still got a couple weeks to close out March, so the first 3 months of the year. Our published expectation for GDP growth in Canada for this year is 1.3%. Last year, GDP growth in Canada was a revised 1.7%. No one is calling for a recession in Canada, so I guess that's a good thing. But we are looking at lower economic output for 2026 as compared to 2025. As we move into April, we'll be moving into one full year of tariffs as they've kind of affected the world. And so it would make sense that as the repercussions of lower trade between our largest trading partner and then taking our largest trading partner and their trade with the rest of the world, if we make the assumption that tariffs are inefficient, and some people debate that, but I would be one that would say tariffs are inefficient, is that we would expect lower economic output, and we are seeing it. Now, in the background, we are seeing some key investments in infrastructure. We're seeing some investments in defense spending. We are probably going to see an elevated rise in commodity prices, at least in the medium term. So those things bode well for Canada. But Canada is also a cyclical economy, so there might be some components of the Canadian economy where we had higher expectations, and now we might see some of those expectations roll off. So I would say we're holding up relatively well. The TSX is on a relative basis outperforming the US market. And my guess is globally, Canada is probably being seen as a relative safe haven through this period, specifically when we think of what's happening in the Middle East.
What about crude oil prices and how it's affecting us? I mean, there's been volatility at the pumps. That's what people tend to equate that to is what was it? It was $1.07, then it went to $1.49. Now it's $1.37. At some how is it affecting Canada from a economy point of view?
Yep. So, Canada would be a net exporter of oil and gas. The Americans would also now be a net exporter of oil and gas. But those higher prices, because oil and natural gas are global commodities, they do end up factoring into our equation here. Now, I had to remind myself a little bit about just exactly what happens with the supply of oil in other parts of the world. So when we think of oil coming out of the Middle East, and probably most of our listeners have seen this over and over and over and over again, about 20% of global supply comes through the Gulf. Now, what's interesting is that if we take a look at some of the major buyers of that oil, and China would be one of the major buyers of that oil, Pakistan and India would also be large buyers. From the loading of that oil to the actual oil tanker making its way to its final destination can be anywhere between 35 and 45 days. Now, that I think is really important because what we're actually seeing happening with oil prices is that we're not actually seeing the shortages yet, because a lot of those tankers that left 2 weeks before the crisis are just now kind of landing in port, right? So what we're seeing with oil prices right now is we're seeing April delivery of that oil. That's what's getting built up. So it's that future price. It's really going to be a difficult job for oil traders and then oil producers who are always looking to hedge their price, because they always need to be thinking about what price they're going to get to be able to offset their expenses. So if this event is short term, then the oil traders will find a way to average out that higher oil price in the short term. If these events go on longer, 6 to 9 months, then again, we would expect those oil futures to probably go higher and stay elevated and have a higher average price for the whole year. And then, if we can assume that at some point this is resolved and now oil futures can come down, it really kind of depends when they can come down. And for example, and then for the course of this year, how many months or weeks did we have relatively low oil prices versus higher oil prices? Going into this event, we had relatively low oil prices, and you could almost argue that we had a glut of oil, meaning some of the world's biggest producers, i.e. Saudi Arabia, they could actually have put more money on the market, but it would have depressed oil prices lower. So, say in terms of usage here in Canada, we wouldn't be concerned about running out of oil and gas, but certainly we're going to see these higher prices. I think the other thing that's really important is it's not just oil and gas that come out of the region. There's some other really key commodities that come out. So, for example, nitrogen fertilizer, about 40% of the world's supply comes out of that region. Aluminum, helium, some of the other really key commodities come out of that region. So we would expect this, again, and I think we talked about it in our last podcast, definitely has inflationary effects. But in terms of whether or not we would expect to have oil shortages here in Canada, not so much of a concern here as they would be, say, in Europe.
Okay, recently I was looking on social media. I saw Ryan Serhant. He's a very notorious real estate agent
Yeah.
in New York.
Yeah. Yeah.
He's on TV, and he was talking about how AI ruined a $50 million real estate transaction for him because one buyer and one seller were both asking AI, and it ended up giving them second thoughts on that acquisition, that sale, that purchase. And I just thought, wow, it's interesting how AI is affecting investment in real estate just because people are curious, or and AI isn't always right. But how is AI, artificial intelligence, disrupting investment opportunity right now?
Yeah, I think I might have seen that episode of whether or not it was $1 million listings, or I also remember that Ryan was given the option to take his commission check in Bitcoin at some point too. And had he done that, his commission would have been something like 30 times higher. I can't remember the exact specifics, but he's good. So I think we're going to find AI has a number of disrupting effects. But I would say right now, what portfolio managers like me are struggling with regards to AI is that we take a look at the obvious winners. So the hyperscalers, the big tech. So this would be businesses like Microsoft, Alphabet, Google, Meta, Tesla, Apple. I'm sure I'm missing one. And our concerns there is they should be winners, but they look very expensive from a stock perspective. They almost look closed off, or at least a little bit of closed off for new capital, just because their stock price looks so expensive relative to their earnings. So there's kind of one issue. And then when we look at the other part of the market, say in the S&P 500, the other 493 businesses, we're trying to pick the winners and losers of AI. So just kind of how with Ryan Serhant, he was a loser in a transaction. And probably his, person selling, the person buying were probably determined, are they winning or losing in this transaction? I think it's very difficult to say that even with large companies, Fortune 500 companies, is that right now they've all come up with what their AI strategy is going to be. But as investors, we're trying to look 10 years down the road with these businesses and saying, are you going to be a net winner, a net loser, or completely irrelevant? Like, are you just not going to exist because your business has been replaced by somebody that can do your business better and cheaper? So what do we do? Well, in the short term, we take a look at adoption of AI and we say, who is seeing some efficiencies, who is publishing what their efficiencies are, and who's being proactive in terms of AI adoption, and then specifically looking at who's going to be lowering their costs. So we actually even just saw yesterday with Meta. Meta announced that they're going to reduce their workforce by 20%, and then reposition their resources. That would be a smart way to run a publicly traded company. I think the other thing that we're looking at is trying to find the businesses that are the picks and shovels of the AI business. So in order to build out the future of AI, what are the building blocks of that build out going to look like? We certainly know it's going to be energy, because it's going to take gobs and gobs of more energy to run this. I think they say that in North America alone, this is like building out 50 cities of 1 million people in terms of the additional usage of AI over the next decade. And we had BCE make a big announcement either this morning or yesterday about a big AI data center in Saskatchewan. And so again, looking to go and say, okay, how are these businesses going to be able to monetize AI as we continue to see the build out? So we certainly have disruption. We know that there's going to be winners and losers, and there are going to be some businesses that are probably 50 or 100-year-old businesses, which we're going to see in the next 10 to 20 years. They are going to disappear. They are going to become irrelevant. They will become like Polaroid film in a digital camera world because of what AI brings to the table. So this is this is the work that we do, and why we really benefit from having BMO Capital Markets as a research center of excellence. And it's going to be an evolving story from now going forward, something that we can't put back in the box.
Great chat today for wealth management and to start your investment journey. Find Patrick's contact info at www.patrickmleonard.com. If you're watching this on YouTube, please subscribe, follow, like, leave a comment, and any questions that you may have. And there you go. That's the Wealth Roundup for the week of March 20th. With Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Thanks, Patrick.
Thanks, Terry.
This has been the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. I'm Terry Evans. The Wealth Roundup is part of the Reluctantly Podcast Network.